Your Next Big Move podcast for anyone involved in the buying and selling of businesses that wants to know how to do it right. Hosted by Zoran and brought to you by Exclusive Business Sales. Sell your business with certainty.
Hello everyone. Today my guest is Abhishek Maharaj, a commercial finance broker and partner in Win Quote Finance. Win Quote specializes in commercial and business loans, and Abhishek has over 20 years experience in finance industry, both through his work at major bank institutions and his own business. In this episode, we discuss the world of commercial finance and explore the best ways to raise money for purchasing a business. We'll also be learning about how major banks approach business loans and how to increase your chances of obtaining finance. So let's get into it. Hi Abhishek, so let's talk finance.
Let's do it, Zoran.
Okay, what I want to talk about today is a lot of people, a lot of buyers especially, when they come to us, actually don't understand what's involved in getting a business finance. And often they think it's much easier than what it is. They compare it to residential finance where you put 10, 5%, 20%, and the bank lends you everything against the real estate property that you're purchasing. Yeah. Commercial finance is very different to this. And what I would like to in this conversation to unpack is exactly what the differences are and how to go in obtaining and where to go to obtain the finance.
For sure. And that's where we come in.
So let's just talk about lending market in general.
Yeah.
How's the lending market at the moment? Because what's happening in Australia and economy is that interest rates are going up.
Yep.
Property prices are adjusting. It's getting much harder to actually borrow the money to purchase the property because banks are looking hard into serviceability and everything else. Yep. But what's happening in commercial market?
Yeah, look, so we've seen a lot of regulation happen over the last 3 or 4 years. It's probably been more about 6 years. A lot of regulation has come in. There's a lot more information in the market. Technology has certainly advanced. The lending market itself. With COVID, there was a lot of complications there. So where we stand right now with the business lending market is that there is a market of increasing interest rates, but banks and lenders are certainly turning their attention to commercial lending, given the less regulation compared to residential funding, and it's a vehicle for them to lend some money out. So I think we're going to see definitely an interesting 2023 when it comes to business finance, and with the entrance of new competitors in the market, fintechs, a lot more information available. There's definitely watch this space.
A lot more options for
100%
for borrowers.
100%, a lot more options, a lot more ways to skin the cat as such. So. There's different ways we can maneuver things to get deals done.
So are you expecting that criteria is going to change, or that the offering is going to change from the bank's point of view?
Look, the criteria, let's look at an example. Sort of, banks, they used to lend unsecured and they stopped during, with the high level of regulation, and then now they've changed again and they're coming back into doing some unsecured lending. So their criteria are adjusting to be a bit more favourable to business owners, given they want to try and lend more money to business owners. So criteria is definitely evolving. With fintechs, you're looking at a situation where lending can happen within a couple of days, as opposed to traditionally, banks taking months and if not up to a year to get things done. So the evolution of technology and delivery to market is definitely changing.
So are the big four and the traditional lenders, are they following that suit, or are they just adopting, or what's happening?
That's a good question. I think the offering itself is somewhat a little bit different, because traditional lenders can tend to take more levels of security. They tend to lend over and above what these sort of newer entrants are doing, and their proposition is pretty much formalized. We know what they're doing. So the crux of it is that the major banks are still offering to lend, but they're still asking the same level of questions, if that makes sense. But it's just about how, as a business owner or as a financier, how do we maneuver through them in the most efficient way possible?
Well, the fintech companies. Do you want to explain that for people that don't know what a fintech company is?
Yeah, look, fintech companies,
fintech finance.
Financier, someone that or a lender that, comes into the market and uses a bit more technology around their delivery. So they've got, software in the background that analyzes a current business's bank statements and lends based on cash flow. A lot of them are coming in to provide quick and easier loans, but they tend to be more expensive, so depending on what type of solution you want for your business, fintechs are making it easier, but it may be more expensive
and the
solution.
Terms of repayments are short.
Yeah, that's right. It's like a 2-year loan term, 1-year loan term.
Yep.
So
what's the normal interest rate when you're looking with fintech?
It could be like 10 to 20%, so it's really a cash flow loan, someone that needs money to jump in quick to assist their business. When it comes to acquisition, you tend to need to focus on dealing with the traditional lenders because they can provide more of a holistic solution using other aspects of collateral and security to get jobs done.
So fintech is used when it's a bit harder to borrow or when you need fast money, there's opportunity that you definitely can
100%
use fintech, and it's going to cost you more money. But if the deal is really good, that you can do something or buy a piece of equipment that's going to really, really help you.
Yeah, or even when acquiring a business, if you have a current business and you want to buy the next business, they can be fairly nimble. They can look at your bank statements. They can look at the business that you're buying, and they can lend against it. They tend to do lower loan amounts, so there's sort of smaller funding assignments that they do.
So what are we talking?
Yeah, look, they can go from anywhere from 10 grand to say 500,000. Whereas if you're trying to push up to some of them are going up to $1 million, but there's a bit more work involved in trying to get the solution organized. But when you're looking to finance or buy a business, well and above that, then you need to go down a bit more of the traditional route. So because they deliver quick to market, they tend to not take as much risk because they want to limit their risk per application that they do. So therefore they restrict their loan amounts that they offer. Okay,
so when the bank lending to purchase of the business, what are they looking for? What security they want? How the whole process works? What are the terms? Let's talk about that.
Yeah, that's a great question, Zoran. I think it's important to understand this firstly when going into buying a business or going in to get finance for a business that you're looking to acquire, or even your existing business. They're really looking for, a lot of banks are now looking at a fairly common sense approach where they want to see how the business is going to be managed once they provide the funding, and most importantly, how they're going to pay the loan back. Because the last thing they want to do is give money to someone that, can't repay their debts, if that makes sense. So they look at that. They are doing unsecured lending, and even the traditional funders are coming back into the market and, offering some unsecured solutions, which, they sort of cut out for a while back there. But I think there's a lot of competition coming in the market, such as fintechs, such as, neobanks, other lenders that are trying to, compete in that SME space. So traditional funders are having to come in to try and compete with the unsecured aspect. But they will look at, where the application needs strength. They will look at the security. They will look at your current serviceability. They'll look at the future serviceability of the business that you're buying.
So that's if the existing business buying new
another
business.
Even if you don't have any, if you don't own a business at the moment, they do want to see what skills you have that you can bring to the business to support.
Okay, let's unpack that a little bit more.
Yeah, for sure.
Purchaser wants to buy the business. Yeah. They're going to look at, let's see what your experience is, industry 100%. And business operations.
Yes.
Then let's look at what the business that you're buying, it's actually turning off as a profit, and what parts of the profit of those profits are available for servicing of the facility that we're going to provide.
For sure.
One thing that they don't do, a lot of people think they do, is actually looking at the value of the business and then lending against that value.
Yeah, that's a great point. In this space, for the SME space, it's rare that the bank does a valuation on the business, especially when it comes to the goodwill aspect of an acquisition. When you're buying assets in a business like primary and secondary equipment or property, of course you do need to do a valuation. But when it comes to goodwill, it's very rare that the bank would do a valuation to, value the amount of goodwill that you're purchasing when it comes to a business purchase transaction.
So they focus on profits that the business provides, and how much. Again, I said this again, but I think it's important.
Yeah,
I said this already. What they're looking is serviceability. Has the business that you're going to purchase, will this business be able to
afford the debt?
To afford the debt.
That's exactly right. Look, it's at times they will question the amount that you're trying to buy a business for. Let's just say if the EBITDA ratios are very large. So that if you're making if the business you're buying only makes $100,000 and you're buying it for $2 million, there's got to be something else behind it. So if there's no other forms of security or property involved, that's when the bank will ask more questions. But if it's a general industry standard EBITDA in the business, say an engineering firm or a coffee shop or whatever it is, they rarely will ask for a valuation or dig any further. They'll lend based on the property purchase or the business purchase price and provide you a certain ratio against that.
Okay, so let's say we're purchasing manufacturing business.
Yeah, for sure.
And that that manufacturing business got $1 million worth of equipment.
Yep.
And asking price is $2 million.
Yep.
Would the bank structure this as a 2 loans, or how would they go about it?
Now, look, you can technically, you can look at it on a 2-prong basis, right? So depending on the equipment, if it's primary or secondary equipment, which means that they have a good auction value or a second-hand value, where you can easily
let's just assume second-hand value of the equipment is $1 million.
Second-hand value, auction value, is $1 million. So technically, you can lend 80 to 100% against that equipment, right?
Mm-hmm.
And then for the balance of the goodwill, you can lend a certain ratio against that. So you could probably do about 50 to 60% of the goodwill aspect. So technically, without any other forms of security against that business, if you bring in, say, $400,000 to the transaction, being the 40% against the goodwill aspect of the of the loan, we can fund pretty much the whole equipment value plus 60% on the business, and from there we could technically do 1.6 million loan against that.
Would there be 2 separate loans, and would they have a different
amortization
terms
period,
and amortization periods and interest? Or would that be packaged in one? Or
look, it depends on the funder, but usually you'd see something like this packaged separately, where you'd look at asset finance loan against the equipment, and then you look at a goodwill loan. Generally, for asset finance, they usually go up to a 5-year term. They don't really extend too much further than that, unless it's sort of new equipment or certain lenders' criteria. But industry standards about 5 years. For goodwill, as long as the lease is over and extended above that term of your loan, they'll look at up to 7 years without other forms of security.
And it would be high interest on unsecured portion.
It would be slightly higher, so it's not going to be ridiculously higher in this example that you've given me. Obviously,
because the base is higher.
Yeah, that's right. That's right.
They're gonna hit you hard on the equipment already.
That's right. That's right. And look, obviously, don't quote me on it. I don't have my pricing calculator here that I can give you the exact rate, but and each situation is independent of its own. So this is not an exact rate, but look, on that goodwill aspect, it will be slightly a little bit more expensive. But generally not too far off the asset value, asset finance aspect of it.
So when you look at the residential mortgages, all right, and how many points above it's normally commercial loans, normal commercial loan price?
Well, if it's security backed, like let's just say if you've got a
security backed, forget the security.
Forget the security.
So there are 2 things here. We go one example that we're talking about. So we got the equipment. And the other portion is unsecured. How much equipment would be above normal residential rate, and how much roughly?
Roughly, look, it'd probably be about 2 to 4%. Okay. You're looking at residential rates being around 4 to 5%, whereas asset finance might be 7 to 12 or whatever
Today.
it is. Yeah. So
And what about the other goodwill part, the unsecured part?
the unsecured part, as I said, would probably be around that 8 to 14, somewhere around
8
about
to
there.
14.
Somewhere around about there.
So this may gonna sound pretty sharp
yeah.
to somebody coming from the outside.
Yeah.
Especially if they never bought a business because they got used
Yeah.
to this 5%, 3%,
Yeah,
2% rates.
Definitely.
It's not the same thing. And
Yeah.
you need to understand. Also, it's not over 30 years. It's over 5 years or 7 years. So too often I see first-time buyers go through the process thinking they can do something.
Yeah.
And then when they actually get the finance on the end, they say, well, we can't actually do this. This is not what we're planning.
Yeah.
Because we were planning much more money to be left over for us. So they need to understand it's possible to finance a business, but you'll pay for it.
Yeah.
It'll cost you.
100%.
And also more cash you get into it,
Yeah.
well, more money is going to be for you, for business to support your lifestyle because you won't be paying interest on that portion. But another thing that there was some conversation about this fintech.
Yeah.
I don't know, I was watching something or listening to someone.
Yes.
And they were talking about this 15%. He goes, oh, that's a robbery. Well, it's not.
Yeah.
Because you're getting a money over 12 months.
Yeah.
So if you borrow $1 million, well, you're going to pay actually less than 150 grand if you can pay that off in 1 year's time. Sometimes we take this loan on 5 or 6 or 7, 10 years, and they actually end up costing us more money on the long run.
Yeah.
All right. So, but,
I think
they fit the purpose.
Yeah. The situation is that, commercially when you buy a business or when you're going into business, you got to be confident in your ability to, grow that business or even foster the current, trading of that business. So you're going in to make money, right? So the cost of capital you should be addressing before you buy that business to say, look, talking to your advisor or the bank or whoever it is to say, look, my cost of capital is going to be this, 7%, 15%, whatever it is, but I'm going to make, an X amount of dollars that's going to outweigh that. So it's different to residential because your loan and your income earning capacity are two different things. Whereas in a business, you're molding it together. So your loan and your business needs to correlate. So that with that money, how are you going to make more money?
So cost of capital is greater, but the returns are greater. Well,
that's technically the concept of buying a business, right?
Technically,
because
it
that's
could go.
right. It could go the other way. So we've all seen it. We've all seen it. Everyone has dreams to buying a business, and then when they get the business.
So this is a good segue to this.
Yeah.
When the bank's lending to a borrower that's buying a business.
Yeah.
You mentioned something earlier that they look at obviously security, but they also look at your capacity or ability to run. Ability to run the business.
Yes.
So how do they assess someone's ability to run the business?
Yeah, look, that's a very good question, and it could mean different things to different applications and different people. But the key things that they look at, if that person has industry experience, if they're going into a coffee shop, do they know how to run a coffee shop? If they're going into an engineering business, what's the experience in engineering? If they're servicing a aged care facility, how do they know how the business works? So they will look at your industry experience, but they'll also look at your business experiences because we've seen plenty of technical operators go into an industry but not know how to run a business as well. So we need to demonstrate, or the lender needs to see that from industry perspective, from management perspective, when they acquire this business or when they work in this business or own the business, how are they going to effectively manage the business?
So when lender said, okay, I want to see the applicant's previous experience in running a business in the industry, what do they need to provide?
Yeah, look, it needs to be a resume. It needs to be, sometimes on your tax returns you can see that they've worked in that business. So there's got to be some level of verification, but it's got to be some type. That we can look at the business plan as well, what their strategy is from there.
So you got a CV, but you got to prove that you actually worked.
Sometimes you do, sometimes you don't. But obviously, going into a finance application, you want to make sure that you're providing true and correct information, because if the bank picks up on that you're
would it depend on your history as well with the bank, if the bank knows you or not really?
Look, it can help. It can help depending on what level of relationship you've had with the bank. If you just have a transaction account, it really doesn't really matter, right? If you've had previous lending, if you have yourself support there or a dedicated banker, it's a different story, right? If you go from so not really, but
okay, my industry experience is kind of easy to explain, or buyer's industry experience. Well, this is where I worked before, and this is my education, and this is my work history. What about the business plan? How detailed business plan needs to be, and do they actually read those business plans?
Look, I've seen business plans from 1 page to 100 pages, right?
Okay.
But I do see big value in providing a decent business plan. The reason is, lenders, it may seem like, you provide them 1,000 pages of information. Are they even going to look at it? Is it just a tick box? But the business plan is very important, because at times, just to say for a commercial application, the credit managers, only have to do 1 or 2 a day. So they're going through your proposal with a fine-tooth comb to see, if you're, viable and right for this business, subject to other factors as well. But the business plan is an integral part that brings it together.
Because I've seen some of the bank's requirements, what needs to be included in the business plan. It's pretty comprehensive, and it's really good. It's talking about the risk and talking about the risk mitigation. Is going into exit strategies, and then it goes into operational and even marketing.
The practical aspect.
Very practical. And when I was looking some of the requirements from certain banks, I was pretty impressed. I mean, it was put together by somebody who really understands a business.
Look, I think a good way of looking at it is that they want to know that you are the right candidate for this business. So it's really another level of due diligence. If a third external party, such as a bank, approves your application, they're looking at it holistically as a somewhat independent party or outside of the vendor purchaser transaction to verify that, look, this person is, viable to run and operate this business from our perspective, because we're actually going to be involved in this transaction as the financier. So when they do their level of due diligence and they give you a approval as such, they're also
backing on you.
Yeah, they're backing you as well. So sometimes you can prove that third level of authentication or verification that you are right for this business. Not saying that they get it right all the time.
What you said about due diligence, it's a good analogy, because as the buyer looks to purchase a business, buyers doing their due diligence not just on the business but on the owner.
Yep,
right?
That's right.
And
they can get emotional as well, as you can see.
Correct.
They get emotional. They get carried away. Oh, this is a great business.
So you got to look at you have to look at the bank same way.
Yeah.
So the bank is now doing due diligence on the business, but also on the purchaser.
That's right.
Because
holistically, if that makes sense, from all aspects.
Well, I'll get into this holistically, but
it's a great word, isn't it?
I don't even know what it means. All right. So, so when the buyer's buying a business, you want to make a right decision, and you want to make sure that investment's gonna return, pay off, and it's not gonna disappear.
Yeah.
Well, you got to think from the bank's point of view. They want same with you, so you got to sell yourself to the bank.
The last thing they want to do is back someone that's going to go bust. Because if you go into a situation where it doesn't work out, it just becomes very complicated.
But what I'm seeing, and correct me if I'm wrong, but a little bit more appetite in last month, say last year or two, from the banks to go into to back the jockey more than a horse, because they're saying, well, okay, we're gonna go unsecured, we're gonna charge a little bit more, but they're gonna do much more due diligence on the person buying a business. In the past was, well, there's no security, we're not gonna look at you, and you had to go. Well, it wasn't like that, but it was.
It appeared like that, right? Like from a purchaser, from a business broker, from an accountant, from an advisor who doesn't deal with banks on an everyday basis. When you do get a negative, interaction with the bank, it would appear that 2 out of the 3 applications I did had a very similar response. now you're seeing things open up a little bit more.
Yeah,
and be a bit
they
more
work.
positive,
They work hard on that, and I think
Yeah.
that I see that as a positive for business sales in 23. Yeah,
100%. I do definitely see that as a positive as well.
I want to go back to holistic.
Holistic, lovely
What
word.
do you lovely word? What do you mean? Like people throw the holistic. What do you mean by holistic in this context?
Yeah, well,
lending money?
holistic means, like, from a funding perspective, is that a number of factors make sense. It's not just the one thing. It's not just the business that's great. It's not just the purchaser that's great. It's not just the, the product that's great. It means that, when you look at a business and you look at the purchaser and you look at the transaction at hand, does this case study make sense? And does it
complement
each other? Is it the right fit? Is the right marriage? Is it something that's going to really, do well for both aspects, for the business and for the person coming into the business as well.
So to summarize, if you're going to the bank to borrow the money,
Yep.
make sure that you got everything ready, all the financial, all the information on the business that you're looking to
Yep.
purchase, all information on yourself, and a good business plan, and that will improve
Your chances.
your chances of getting your money, but not only getting money, getting your money in timely fashion.
Look. The analogy I use is that if you go to the bank or a funder unprepared, they're just going to sort of put you to the back of the line because they really only want to look at something that is complete. And the easier you make their life, the quicker response you will get. So if you're drip feeding them information, it really doesn't look professional.
So explain to me,
Yep.
prepared and unprepared. How does it look from the bank's point of view?
Yeah, look, so, obviously they want someone that's going to come into a business that has their life together, if that makes sense. Not really life, but has this business case together. So they want someone that will come in and present, if they have all the aspects of the application in front,
what are the aspects of the application?
So one could be, all the information on the purchaser. So the person buying the business, you want to have all your tax returns, financials, pay slips, resume. You want all that in order. And then the business that you're buying, it's very important for the vendor to have all their information ready. So the business
and up to date.
Up to date, that's right. So most recent year financials, interim financials, any new contracts that they might acquire or that's going to help them their business perform better. If we provide that as a package deal with everything to the lender, and the thing that ties both sides together, the purchaser and the seller or the business that they're buying, is the business plan or the business case with a cash flow forecast and demonstrating what the future is going to look like once this unity happens.
So people that come to you to
Yep.
ask for the money.
Yeah.
How many of them got that ready?
Look, it is very rare, but it's for us to guide them through that process.
So can you help them? So would you go to the bank and say, okay, this is what we got so far, or would you say no? Let's organize all this.
Look,
and then go to the bank.
From a business process, we try and make it as easy as possible to get some level of indication up front, because it is a lengthy process to do all your due diligence, business plan, cash flow, get all the information together. But at a high level, if there's some core information that we can get, such as an IM with some financials and a little bit of a asset and liability position of the buyer with a little bit of the experience, we can understand what securities on offer, what the loan amount we need, what the equity position of the buyer is, and just get a high level yes or no, we want to invest time in this transaction.
And then figure out, okay, well, to support this further, these are the
things we need. Yeah, so we try and make, because no one wants to invest time into something. Even a buyer doesn't want to invest time into something that's not going to happen. We all want to work towards something that is going to eventuate and get to settlement, get to the person running their business, moving on with their life. So we want to try and
because it takes time.
Yeah, it takes plenty of time.
And it also costs money.
It costs money. It, emotional investment. There's a number of things that...
this is a hard question, but...
I like the hard questions.
Okay. Well, here's a hard question. I'll give you a really hard question.
It sounds good.
If I give you all the information put together very well,
Yeah.
all right? How quickly can you give a non-conditional...
Yeah. Unconditional, yeah.
Unconditional approval on the finance?
Look, I'm not going to use this silly analogy of how long is a piece of string, you know.
Please
But,
don't.
please don't. But
I want to ask you a question. You want a hard question? I'll give you a hard question.
I'll give you a hard answer too. All right.
The reason, because everybody, like, I mean, are we talking?
I'll be practical
Yeah,
around
be
it.
practical.
And the thing is, you know, I will say it is subjective to the person's situation, but you know, we've seen things turn around in a couple of weeks, and we've seen things turn around in 12 months. You know, and what we try and
So what was the difference between
the 2
weeks
weeks and
and
months?
month turnaround?
What we see, one is having all your information prepared, but you're saying in this example everything's prepared.
Everything's ready.
What we're seeing is that things that take a couple of months is when there's variations in the transaction. You know, when, you know, sometimes people come to us to get a pre-approval subject to, you know, signing of contract or lease approval or franchisee approval or a number of aspects. And then if things change from what the deal looked like to start and where we are at the end of the day, these things prolong the finance application process. But generally, if you provide all the information and you have a signed contract, obviously it could be subject to finance or whatever condition to protect yourself is, you know, within 2 to 4 weeks we can turn something around. You know, the people that we deal with in these banks and institutions, they are people as well. So it's not just a machine where you press a button and everything happens. They could have, current work constraints or be certainly busy at certain periods of time.
Working from home. So
working from home, that's right, you know, so, there's a good TV show on, you know, so there's plenty of things that could factor in delays of an application, but...
New season of your favorite show and you
binge
binge watching,
that's right. And I think the key thing is with the person you're dealing with who manages your finance application, you really need to be confident with them to ensure that they're guiding you through the process. So if there are delays, you know, let's just be, you know, transparent around it and keep everyone involved. There's so many occasions where I come in sort of last minute and people are wanting the finance after they've done everything and they want it done in a week. If it's not possible, you really need,
Also, once when the banks give you approval, they do tend to ask for further documentation and further
that's right. It'll be approved subject to, you know, further verification on the contracts that are coming through.
Now, is it possible to have a pre-approval for business purchase? Let's take this example first. If you own the business already, you own a profitable business and you're thinking of growing through acquisition, is it possible to get some sort of good indication? Not we'll consider it, but yes, subject to business you're purchasing, we will lend you up to $2 million.
That's a good question. And it's not like residential finance where you just look at your servicing and everything's ready to go. It is highly subjective to a number of factors of the new business that you're buying as well. The serviceability, the value, you know, they could give you look, everything looks all right, subject to the business you buy. But then the subject to the business you buy, there could be a number of factors there that affect the final outcome. So we rarely want to give everything's going to be okay, you know, subject to the business you buy, because...
I know, but like in order for somebody to make a decision that he's going to go and look for acquisition and negotiate, they need to know to a certain level of
what we can
confidence that they can actually raise those funds.
What we can provide is, you know, our experience and our understanding as to what, you know, can possibly happen subject to the business that you buy.
God, I love this subject.
Hey, that's also a nice word. Listen, you know? What was it? Holistically subject
after
to.
After we finish this podcast, I'll take you for lunch. Subject to me being satisfied with the quality of your answers.
Man, hey, it gives me a chance. All right? I have a chance. Let's just say I have a chance, right?
No,
so,
look,
look forward to this lunch date. You know? So
it is. Like I know that you can, I know you can look at it, but can you actually go to the bank and have a bank look at it and said, yes, look, this is a really good application. Obviously, we need to look at the business. And
they're not going to give us anything formally in writing, but what they will give us, if we sit with a banker and a reliable source in the bank to say, look, this person owns a property, he's got plenty of equity, he runs a manufacturing business, he's been in the industry 20 years. XYZ, he's looking to acquire another business. Does it seem reasonable? They'll say, yeah, look, it seems reasonable.
Look, I'll challenge you on this again.
Yeah.
All right, and a lot of bankers and people that work with the bankers, which is you, do start with, this person's got a property.
Yeah.
I know if I have a $10 million property, that the bank's going to give me $1 million. All right?
Yeah.
But let's say I've got a business and I've got or somebody's got a very successful business.
Yep.
But he doesn't want to bring his property into equation. I want to keep that separate from, risk mitigation point of view. I know that the bank wants my firstborn, but they're not getting it. And they're not getting a house. Yeah. So I'm prepared to put certain guarantees, and I know it's going to come with the personal guarantee.
100%.
But I don't want to put equity, my home property, my home, my family home as a. So you said this person's got a property. Yeah. Do they still look at if the person's got a property, but they won't take it as security? Or can we just exclude that altogether?
You can technically exclude it if you really need to, or if but then you got to see what else you can bring to the table. You do need to have equity to put into the transaction. Or you've got an existing strong.
Let
business.
me ask you a question. Yeah. So the accounting practice that turns over $2 million wants to buy another practice that turns over $1 million.
Yep, you technically 100% fund that. Technically, subject to.
Subject to what?
Subject to XYZ.
What's XYZ? Get with
look, obviously,
jokes aside, but subject to what would that be?
Yeah, look, it's subject to the purchaser's credit history, understanding the way that he's understanding his current business, looking at the new business that he's buying, how it will integrate, it will fit the business.
So it's not a subject to bring us more cash.
No. It's technically you could go 100%, but then you got to see what lending they've got in their business currently. So you're leveraging off the current business to purchase.
So you would combine
business.
both businesses together.
Yeah, and get a
you would get some sort of what do they call it now? It's not fixed and floating mortgage.
You get a GSA, a general security agreement.
General security over the both businesses.
That's right.
And against that, they would lend 100% on the purchase. Yeah.
Technically. Yeah, with the little asterisks at the bottom.
Yeah.
So you just have to make sure. Obviously, we can't be committal to everything unless you get something in writing. But that's technically how it can happen.
Yeah, I understand, because if he's already behind on his taxes and everything else, it's not going to happen.
That's right. Then he's in trouble with ATO or whatever XYZ.
Whatever. But if you got a clean, well operating business,
technically you can go 100%.
You should be able to
and that 100%. That doesn't just work with accounting businesses. It could be things like hospitality. It could be things like manufacturing. It could be things like retail trade. There's lenders out there now that will leverage against your current business and the current success in your business to further grow your operation. So
okay, now what? Say somebody who never owned a business.
Yes. We always get those situations.
Wants to get into the business, and he does have a background in the industry, but never owned a business. Yeah. Let's take, for example, somebody wants to get into distribution business. Yep. So there's very little assets. Yeah. They would need to provide more security, I would assume.
So they could get away with just providing equity into the transaction, subject to the business case. So basically, will the vendor who's selling the business hold his hand through the first 12 months? What level of, how strong is the applicant in his current, with his industry experience? Has he been in the industry 1 year, never been in the industry, or been in the industry 20 years? So, and this is the next natural progression. So, could help with if they do want to offer additional security, or their property or whatnot, but I've seen deals where we haven't had to offer security. So that's also subjective to the lender and the full business case. But those type of deals can and are happening.
But you wouldn't be able to provide any sort of pre-approval for something like
this. Yeah, because it's highly subjective on the business that you buy as well. Right. I could give general gut feel around,
let me ask you a question this way. Would you be able to look at somebody's current financial position and say, okay, look, you worked in this industry for this long, you got this sort of cash and you got this sort of equity, I'm very highly confident that if you buy a business in this industry to this amount, we'll be able to fund it, providing you provide these securities. If you choose not to provide a home as a security, we still can fund, but the funding is going to be lower, and
you pretty much.
So you have that's how the process works.
We can do that. I think the key thing there is just to be, in line with all regulation, is the confidence level we can only provide once we get something from the lender, right? But what we can say is it's a worthwhile process to go through, given XYZ, given this is the business that you want to buy, or this is the type of business you want to buy, and this is your current situation. Let's invest time into this process to ultimately try and achieve our final goal.
Yeah, and sometimes you'll tell them I can't do it, so they can go elsewhere, or you can tell them, well, there's no way we can raise it.
Yeah, look, in those situations, and I'm sure you've seen plenty of this happen as well, it's also then up to the vendor to see if they want to vendor finance the application until the funder sees their confidence, sort of say 12 months trading or 6 months trading, and then we can relook at the application once we've seen, them running the business for 12 months. So the vendor, if they have sort of say 40, 50, 60% equity to go into a transaction, but yet they can't get the funding, why not? We get a deferred payment from the vendor and then look at paying out the vendor at a later stage. That's another aspect of it, where there's no financial instruments from a third party getting involved, but it's just the vendor and the purchaser, helping each other out to get to a certain point and then reapproaching the finance at that stage.
So when it comes to the vendor finance, that needs to be disclosed to the bank, because if there's a vendor finance, that impacts serviceability.
Yep.
But that vendor finance can be unsecured, so they can the banks can say, well, okay, your repayments for the vendor finance, we're gonna take over serviceability. Yeah. But now we got more security because we're providing less money.
Yeah.
So do you see those deals happening often with this combination?
Yeah, we do. Lenders obviously charge a price for risk, right? So if they will look at a transaction, and if they see like certain lenders, traditional lenders may not take that risk, but other fintechs, other banks might take that risk to take on an application with vendor finance, which then means your purchaser will be paying a higher price subject to, them putting less equity in and being vendor finance. So lenders will look at risk being, if there's less equity in the vendors being involved, they see that as a riskier application. Not all of them, but that's the general consensus in the industry when it comes to vendor finance being involved.
So providing a vendor finance increases the risk from the bank's point of view. Or did I misunderstand?
It depends on how much vendor finance and what the transaction looks like. I'll give you some round numbers as to what I think what the tolerance levels are. If you've got a transaction where 50% comes from the bank, 40% is from your buyer, and there's just a little bit of vendor finance on the top to get it over the line, given there's just the negotiation aspect of it, or they couldn't come up with that equity, that's a bit less riskier, because your buyer is still putting 40% equity into the transaction. Whether
is
it be
that because there's a more skin?
It could be because the purchaser doesn't have access to all that capital, and that 10% will just be the sufficient amount of cash flow that they need to get into the transaction.
My question is, does a bank look at the more money from the purchaser's point of view as a money down, as a better security, because he's invested
as well.
He's in. Yeah.
There's situations where people approach me and say, look, can the bank do 50% and the other 50% is going to come from the vendor? That means that the purchaser's putting zero risk into the transaction.
He's going to put a 0K as well.
Zero K, that's right. So if everything goes bust, it's the bank and the vendor that needs to worry about it. So that is seemed as a higher risk application. So there's only very few funders that would charge a premium to get into something like that.
So the answer is probably no, but there's a 0.1% chance.
We've done deals that actually where stuff like that happens, where there's vendor finance, the clients put their property in, and there's assets in the business, and we can finance it. So the bank needs to look at their sort of get out. If everything goes to crap and the deal doesn't work out, what security do they have and how much risk are they going to put on that and what premium are they going to charge, So those type of deals are not impossible, but it really...
But you pay more for them.
You pay more for them, and we really need to see what the holistic aspect of the transaction looks like.
What's a lender's fallback position?
That's right.
If there's the assets and you're prepared to give me 20%,
that's
and if everything goes pear-shaped, I'll sell the assets.
I'll sell the assets. I've got a fallback position. You know, so there you can see the example of what level of vendor finance, if any, affects an application and the outcome of it.
For people listening to this, can you give me some examples how the typical structure of the lending looks like when you're purchasing a business?
So
or borrowing, depending on which side you're on.
So like as in the borrowing structure, or
explain to me how. Give me an example of how you structured some of the deals. In order to raise the capital.
Yeah. Look. So let's assume. Let's go to a hospitality business, right? So have an applicant looking to buy a restaurant for $1 million, right? They've got 40% cash plus the probably more like 50%. We keep a 10% buffer for any sort of transaction costs and cash flow. We were able to get them 60% lend against that business, or a $600,000 loan over a 7-year term, which is a principal and interest repayment.
Freehold or leasehold?
Leasehold, so just no unsecured lending as such, so no property backing. We were able to get them 60% against that business, and it's been it's a situation where they have the loan is in the business that they're the new entity that they've set up, and the director provides a personal guarantee. Mm-hmm. We've seen similar things like this happen.
Let's unpack this a little bit more.
Yeah.
These people, the purchaser, obviously had experience.
Yes.
Have they had existing business?
Well, in this situation they did, but we've also done other aspects where they haven't had the...
So they had one or multiple businesses and they wanted to buy one more.
Yes, that's right.
Would a similar deal be possible with somebody who had a business but it doesn't have it at the moment?
Yes.
Purchasing new one?
That's actually another situation we had where they had a business, they sold it, they took a bit of just a career break or whatnot, and then looking to get back into business. They've shown that they ran it successfully. They sold, they sold the business, and as I said, just took a bit of time off, and now wanting to get back into the business game and run their own thing again. So we've seen that happen. Yes.
So similar situation, about 50% unsecured.
Yes, that's right.
Okay,
that's right.
And
excuse me. We've also seen a situation where we have a customer that was buying a business from a different industry, but they ran a business and they were successful in that business, and they're moving to a slightly different industry. And
what were the industries?
So one was a gym that they ran a gym. They sold the gym.
So fitness,
yeah, fitness, and then they got into a marine business. So,
but on the back of the business background.
Yeah, business background. Yeah,
they managed. Bank looked at favorably,
and they also lent against the stock as well. So it was a high stock business. They were able to assist with the funding on that. So it was pretty favorable, and it was one of the major banks as well. So
okay.
Good.
And what about the other two examples that you gave me? Were they major lenders or
just a bit outside the major lenders? So it's still a reasonable rate and a reasonable terms, 7-year terms, principal and interest, and just personal guarantee from the directors.
Okay.
Yeah.
And we touched on this a little bit, but I think it's important to repeat it. So what's the difference? What's the main difference between commercial finance and residential finance? Yeah, and that's for question. People just getting into business, and they just think it's the same, but it's fairly different. So what are the main differences that people should know?
So in commercial lending, you can look at forecasted future income, whereas with residential lending, the bank wants to see you earning a certain amount of income for a period of time to service your property purchase or whatever it is. The second thing is pricing is obviously different as well. Because it's secured, residential loans are secured by properties which are deemed a little bit more safer, given the stability of house prices over the last 20, 30 years. They tend to provide a higher LVR, so they can go up to 95% loans. Obviously, they charge a premium, which is the mortgage insurance, whereas with commercial, the LVRs are a bit less, and they want to see more equity go into it.
Mm-hmm.
And especially in the unsecured space. But now what we're seeing when it comes to lending criteria, this is where the banks and fintechs and other funders as such are moving into commercial, is because the criteria in residential is very highly regulated and up and down. It's A plus B equals C. Do you have your deposit? Do you have your 3 months or 6 months worth of PAYG income? Do you have your security property? Is it valued to that point? Show us your genuine savings and the deal will get done, right?
Mm-hmm.
But now there's a number of unsecured loan options for commercial, and you can really harp on the business case side of the transaction to get lending organised, subject to you putting a good plan and forecasted income into account. The banks can look at so many other aspects, and it's not as linear as a residential transaction. A commercial transaction has so many more aspects which we can mitigate to make sure that a deal gets across the line and a person purchases a business.
Yeah, I like what you said at the beginning. When you're borrowing for residential, your income is separated from purchase.
That's right.
While your purchase in this case is generating your income.
That's right.
They have to be looked at together.
They have to be looked at together. It's a factor of the amount of money you can get from when you're purchasing a business. The amount of money you can get, you can technically invest and make more money, if that makes sense. So it's a commercial transaction as opposed to a consumer transaction where you're buying to live in or buying as a somewhat investment, for a residential property. So they're looked at very differently now, and there's other lenders out there, and there's other options out there that you can now bank on to try and get the funding you need for your business.
So what do you think is going to happen in 23? Here we are, beginning of January 23, talking about this. Where's how the business lending gonna unravel?
Yeah,
is it gonna go up, down, sideways?
Look, I think it's going to remain pretty consistent. I think it's banks and lenders are going to be more out there for market share now to try and given there's a lot of competition there, so they are going to try and do different things to gain more market share. That it is a competitive industry.
Yep.
I think what we need to do as business owners and people that want to try and buy a business is really try and invest our time with the right people that that are offering the money, if that makes sense. I see a lot of what I've seen previously and in the past years is that people are investing time with financiers that just technically won't get the job done anyway, or they're barking up the wrong tree, if that makes sense. So I see with the competition and a bit more of an open market in the commercial space, we're going to see more lenders really invest time with people to really make the transaction happen. So in 23, with a highly regulated financial market, the options are out there. It's just about who's going to be competing for what. So it's I see it's a good opportunity for people.
And from my experience, the changes, like certain lenders going to be really aggressive in certain industry. With certain types of loans, and then they're going to stop, but somebody else is going to...
That's why there's there's so many categories of lenders out there that will be willing to lend to you, but it's just about what your pricing tolerance is and what your
and knowing where to go for the
that's
certain
right
deal.
That's right, because so I see that holistic
again,
that as an industry, commercial lending is going to be a situation where we do have more options now, and in 23, after COVID and regulation is gone, we are going to see that stability and reliability of funders out there. That's what I believe.
So it's a good news.
I think so.
Good news. Now, how to increase the likelihood of getting a finance? Any tips or advice on that?
Yeah, look, I think you have to be realistic. I think that's a key thing. We get from time to time people that are really overbearing with their ambition and really want to try and get something that we know is just not going to work. So we really need to you really need to go for something that is realistic within your means. I think people along with that need to be prepared as well, like we talked about earlier in this this discussion. We need to be prepared with our information, target something realistic, and deal with the right people. It's not I think we had this chat before where you're dealing with people in the bank or people in the institution, and each people's understanding can adjust depending on who you speak to in that institution. So you can't really paint them with the same brush. If you're dealing with a bank manager or a financier or a finance broker who's really committed to assisting your transaction and knows how to maneuver the credit policy to make the deal happen, you got to invest your time with the right people.
And also understands the industry or understands the
that's right
business that you're trying to purchase. He can paint a better picture
that's right
to help that gets across.
And also to increase your chances of getting the funding, deal with the right advisors, deal with the right people.
Okay. So do you provide a service, or can people come to you and say, look, I'm thinking of doing this. Can we sit down together and tell me what's needed and what's the likelihood and what level of information you will need from me and to what level can I borrow without actually going to the bank and doing a formal application?
Yeah, we can do that. We can can certainly do that. And sometimes we have the unofficial chats with our bank managers to run a scenario to them to say, look, to get a bit more clarity and be a bit more sure about that advice we give to our potential customers, and purchasers of businesses. So that is certainly something we can do.
And look, I think it's a useful for somebody is looking to purchase the business.
Yeah.
So they actually know where their level of purchase is. Because I have seen
100%
more than once that people try to do something that in their position they can't just do it.
Sometimes
and they spend a lot of money.
Yeah. Sometimes we look at it like buying a car, right? You go out and you see this beautiful shiny car, and then the last question is, how am I going to pay for it? And so we see that often with people in businesses. They or people trying to acquire businesses. Yeah, this makes sense. This is great for me, but then how am I going to pay for it? So maybe. To increase your chances of getting the money, we got to bring that question to the forefront and have a plan and a strategy in place so that when you see that business that you want, you're ready.
So understand how much you can pay.
Yeah.
How much that's going to cost you to
and get an indication about, with a rising interest rate market, what the cost of funding is going to be. If I'm dealing with a fintech as opposed to a traditional bank, what the pricing differential is going to be. Is it realistic for me? Is it, is my affordability going to be affected? Is my take home every month going to be affected, once I run the business? So, being prepared, you'd rather be over prepared than under prepared.
Yeah,
when it comes to funding.
Well said. Look, I'm not going to ask you about interest rates because no one knows what's going to happen there. But it's a good chance.
I'll get my crystal ball out. And
there's a good chance they're going to go up and to some degree, and it doesn't really matter. Do you think that the high interest rates will impact business transactions, purchasing, business acquisitions?
Look, I think business owners or people trying to get into businesses are entrepreneurial at heart anyways. So they take a bit of a chance of understanding that rates may go up. And it's about how much they want to back themselves. That's the entrepreneurial answer to that question. But I guess from a practical sense, the cost of funding and what rate is being charged by the bank does affect your bottom line when buying a business. So we have to ensure that whether it's from the current financials of the business or from future contracts, how are we going to afford that debt, regardless, if the price goes from 5% to 7%, we need to demonstrate that. And the banks also put their risk margins on top, and their serviceability is sensitized to ensure that they look at 2 to 3% increase in rates to understand that the business should still be able to afford that. So there's a lot more premiums and additional expenses that they put in there in your application to ensure that
checks and balances.
Yeah, checks and balances to ensure that you are if rates do go 2, 3, 4, 5% higher, will the business be able to afford it? So
okay,
yeah.
And it's one more question, last question for you, right?
Oh, thank you. Yes. Is it a hard question or easy?
It is pretty hard question.
Yeah.
All right. So this was really informative for everybody coming into the market, even people that were experienced. Like I think they'll get something out of it.
Yep.
But especially, in my opinion, people that never purchased the business, it'll help them understand, intricacies of actually funding the business acquisition. Now, it's not everything. There's way more to it. I mean, we can talk about this forever and a day. Where do people find you if they need more information on this, and how they can reach out to you? Yeah,
look, I'm sure at this podcast you can put all our details on there. They can. Yeah,
we'll put it in podcast notes.
Podcast notes. Put our details there. Our business is Win Quote. Our website's winquote.com.au. Just reach out. It's got all of our contact details on there. Google search us, send a smoke signal, whatever it is, we'll be there. Look, we've built up a very good reputation when it comes to the business acquisition funding. A lot of industry people selling businesses know about us, so we're definitely pre-vetted. So when you do work with us, you're talking to somebody that knows what they're talking about and really will put your interest first and guide you through that.
Many times.
Many times. So, reach out in any which way. We're always very responsive. We do want, and we're here to help. Our key thing is, Zoran, you've been in business a long time. So same as us, and our families have been in business coming into this country. So we understand the emotional aspects and the aspirational aspects of buying a business. And the last thing we want to do is, put people in a financial product that they can't afford, or get them into a business that doesn't work out for them. So we have their best interests at heart when we talk to them. So we really take that duty of care, talking to our customers and really looking after them. So that's a key thing.
So it's a winquote.com.au, and we're going to put all the details, phone number. Do you have a phone number?
I have a phone number, yeah, I do.
You want
it's not private. It's not private.
Well, give it to us.
I'll give you my mobile number. It's 0430511887.
Repeat that again.
It sounds like a pizza company, but it's not. It's 0430511887.
Thanks.
You can call me anytime.
That's how you're going to find Abhishek. Just call the mobile.
Call the mobile. Give me a buzz. What I really like to do for the people I chat with is, if it's not something right now, it could be something in 12 months. Let's just have a chat. Let's just get you into a point where you understand, what you need to. Let's put a guideline and a plan in place so that when it comes time in 6 months, 12 months, 1 week, 10 years, whatever.
Well, it's important for people to have these conversations so they understand what's possible, what's not possible, so they can realistically
100%.
make their plan for the acquisitions.
They can make their plan. They can, understand where they're going with this all, and know that they're heading in the right direction.
Awesome. Well, thank you very much for your time.
Thank you, Zoran.
And
really appreciate it.
I'll take you for this.
Yeah, you're going to take me on this lunch now, right?
I'll take you for the lunch. I'll buy you lunch. If all conditions are satisfied.
Yeah, that's right.
Thank you.
Perfect, mate. Thank you so much.
Thanks.
Bye.
Need help selling your business, buying a business, or a business valuation? Exclusive Business Sales award-winning team are here to help. Our experience, skill, expertise, and professionalism, backed by our triple guarantee, is assurance for your success. The largest network of buyers and our national coverage will help you throughout Australia in all state capitals and regional areas. Exclusive Business Sales. Sell your business with certainty.